The real estate crisis in China continues, and developers are coming up with new marketing strategies to boost sales. In the past, we've seen promotions like low down payments, free luxury cars, and waived property management fees, but recently, a property in Dongguan, Guangdong Province, made headlines by offering a buy one, get one free deal. This quickly became the top trending topic locally, shocking the industry and drawing more attention to the increasingly competitive real estate market. The property offering this deal is Vanke Group's Zhongqian Century Waterfront. Currently, they have units ranging from 89 to 195 square meters. If you buy a large unit of 140 square meters or more, you'll get a free 40 square meter seaside apartment in Huizhou, also developed by Vanke, valued at over 200,000 yuan. The promotion ran from July 12th to July 28th, with limited availability. Zhongqian Century Waterfront is the first large-scale urban renewal project in downtown Dongguan, covering over 800,000 square meters. According to Vanke's Dongguan website, this project has been a top performer in terms of signed contracts and sales area locally since it entered the market last year. Currently, the average price for large units in this project is about 35,000 yuan per square meter, while smaller units are around 26,000 yuan per square meter, with total prices ranging from 2.5 million to 7.5 million yuan per unit. The free apartment in Huizhou's Shuangyue Bay is located in a popular coastal tourist destination near Dongguan. Vanke says this apartment comes with a 70-year property right, and the development is almost complete. Why did they launch the buy one, get one free promotion? Vanke explained that July is the summer vacation period, and many families from Dongguan travel to Shuangyue Bay with their children. Their main customer group is aged between 30 and 40, making this promotion a good fit for them. Since those looking to buy units of 140 square meters or more match this target group, they decided to offer a linked sale. Although smaller units don't come with a free apartment, their prices have been directly reduced. On August 1st, Vanke denied any significant price cuts and stated that the promotion received positive market feedback. However, they clarified that the promotion has now ended due to the limited availability of special offer units and emphasized that there was no forced bundling of sales. Although Vanke claims that the promotion was well received, Chinese netizens have shared a different view. Some said, "No matter how much they give away, I still can't afford it." And it's not about needing two houses, it's about not having the money to buy one. If you don't lower the price, even if you offer a buy one, get one free deal, people still can't afford a house. It's not just about not being able to afford it. Many netizens are pessimistic about the real estate market. Some people are saying, "The more it's like this, the more you should hold on. In 2 years, prices will be even cheaper." Another commented, "If you don't buy and I don't buy, prices will drop by half." Others added, "Hold on, in 2 years it will be buy one, get two free, and I'm waiting for rock-bottom prices." Even a real estate agent in Shanghai, after seeing the buy one, get one free news, said, "I think it's better not to buy now. Prices are definitely going to drop." A research supervisor at the South China branch of the China Index Academy, Chen Xueqiang, noted that the overall real estate market in Dongguan is still at the bottoming out stage, with a strong wait-and-see attitude among buyers. Although Vanke denies price cuts, both the sales volume and prices in the real estate market have significantly declined. According to data monitored by the China Index, the first half of 2024, the average transaction price for new homes in Dongguan was about 639 yuan per square meter, down by approximately 17% year-on-year, making it the largest drop in the Greater Bay Area. The average price of second-hand homes was 18,477 yuan per square meter, also down by about 20% year-on-year. Moreover, in the first half of 2024, only 7,629 new residential units were sold in Dongguan, a year-on-year decrease of 46%, with an average of fewer than 1,300 units sold per month. This is about 1,000 units less per month compared to the first half of 2023. The apartment market has also remained at a low level, with significant inventory pressure. Some netizens believe that price cuts would be more effective. One said, "If you want to clear the inventory, just knock a zero off the price. Watch, in less than a week, everything will be sold out." Another commented, "The gifted apartment can't be lived in, might not even be rented out. Plus, you still have to pay property management fees. With the high fees for the apartments and the government not regulating them, think carefully before you act." One more added, The main point is, after 70 years, the property isn't even yours. More importantly, it might turn into a dangerous building after just 30 years. Some netizens are skeptical, saying things like, when something unusual happens, there's always a reason. Isn't this a game of offering a bonus when it's about to shut down? And the more they do this, the more uneasy I feel, even though I haven't bought a house yet. Another added, if you're the prey, the hunter will find a way to lure you into the trap. Someone else commented, property taxes are about to be implemented, and they're just looking for someone to take over the burden. Another replied, you're right, whoever buys more properties will be the one paying the property taxes. It's worth noting that Vanke is not the first developer to try a buy one get one free deal. Back in April, during the Qingming Festival holiday, a project in Beijing's Tongzhou district launched a buy one get one free deal, offering a free 108 square meter seafront apartment in Yantai with the purchase of a 77 square meter two-bedroom unit. Before that, the Fuji Yunlong Mansion project in Shenzhen's Longhua district had also launched a similar promotion, offering part of the down payment for a house in Dongguan or a developer-owned unit in Shenzhen's Dapeng district as a freebie. Given the overall pessimistic outlook for China's real estate market, most developers are under pressure to clear their inventory, and Vanke's Zhongtian Century waterfront is just one example among many. In Dongguan, it's not just buy one get one free promotions that are popping up. Recently, several developments have started selling at prices below the land cost. According to a report by China Real Estate News on August 7th, the first development in Dongguan to sell below land cost was the OCT Yunrui Mansion project in Machong, priced at 10,000 yuan per square meter, which is below the land cost of 14,000 yuan per square meter. This project first launched pre-sales in May 2022, with an average recorded price of 24,000 yuan per square meter. Currently, the regular sales price for low-rise units in this project is around 17,000 yuan per square meter. Later on, some projects in the Water Village area also began offering properties at 10,000 yuan per square meter. Another state-owned enterprise project in Hongmei, Dongguan, called Shoukai Shijiayue, launched a batch of units priced at just 10,600 yuan per square meter. These units come with fully furnished interiors and offer a choice of floors. It's reported that these low-priced units are mortgage-rescued properties. This term refers to properties that developers use as collateral to repay outstanding construction costs owed to contractors. To quickly recover their funds, contractors often sell these properties at lower prices. A local real estate agent commented, in the current market, as long as houses can be sold, it's a good thing. The key issue is whether developers can still guarantee the quality of delivery after their profits are affected by falling prices, which is a crucial test for these companies. A social media user on Tencent remarked, the property market can't hold on any longer. The crash has already begun, and we'll see more and more houses selling below land cost. The longer you wait to buy, the better the deals you'll get. In July of this year, Hong Kong billionaire Li Ka-shing's Chengkong Holdings also announced a 50% off sale in their Dongguan Haiyihao Court project. The special offer units were priced as low as 13,000 yuan per square meter, with two-bedroom units starting at 900,000 yuan and three-bedroom units starting at 1.2 million yuan. Chief researcher at the Housing Policy Research Center of the Guangdong Urban and Rural Planning Institute, Li Yujia, pointed out that the popularity of low-priced homes suggests that buyers expect prices to continue falling. This could further lower price expectations and affect market sentiment and transactions. Dongguan, located in the eastern part of the Pearl River Delta, is a world-renowned manufacturing base and a crucial export hub for China. High-value-added electromechanical and high-tech products have been the main drivers of its foreign trade growth, with the city once having a foreign trade dependency ratio of up to 300%. With advantages such as low labor and land costs, Dongguan experienced rapid economic growth, establishing itself as the world's factory. However, in recent years, the economy has taken a sharp downturn following the departure of many Taiwanese and foreign investors. Dongguan's GDP growth rate has plummeted from its double-digit peak to just 2.6% in 2023. The accelerated decoupling between the U.S. and China and the relocation of supply chains have led to widespread unemployment and reports of 4 million people leaving the city, signaling the end of Dongguan's prosperity. Dongguan is one of the cities in the Greater Bay Area. If such an economically developed city is facing these kinds of real estate difficulties, it's easy to imagine the situation in other cities across China. According to data from China's National Bureau of Statistics, in the first half of 2024, the sales area and sales value of newly built commercial housing in China were approximately 479 million square meters and 4.71 trillion yuan, respectively, representing a year-on-year decline of 19% and 25%, respectively. The area of new housing starts was about 380 million square meters, down 23.7% year-on-year. The CRIC Research Center's statistics show that in the first half of 2024, the top 100 real estate companies achieved sales of about 1.85 trillion yuan, a drop of 39.5% year-on-year. On July 29th, Caixin reported that Lu Ting, the chief economist for China at Nomura Securities, stated at the 2024 Greater Bay Area Chief Economics Forum that China's economic recovery is not meeting expectations. The data indicates that this real estate crisis is quite different from previous ones, and the industry is facing three downward spirals simultaneously, making it difficult to recover on its own. The first downward spiral occurs between housing prices and real estate sales. Over the past 3 years, housing prices in many Chinese cities have continued to decline, leading potential buyers to hesitate, which then triggers another round of price drops. The second downward spiral involves the issue of ensuring project completion and the relationship between completed projects and new home sales. Although the project completion issue wasn't severe in first-tier cities, quality problems with new homes are now affecting residents' willingness to purchase, even in these areas. The third downward spiral is a result of declining new home sales, which leaves developers without the funds to buy land. This reduction in land sales revenue then impacts local real estate markets. Lu Ting noted that before this downturn began, real estate accounted for about 1/4 of China's GDP, with its contribution to national fiscal revenue peaking at 38%. However, since 2023, the real estate market has been sluggish, with all key indicators continuing to decline by 10 to 20%. He emphasized that the industry is struggling to recover on its own. He also pointed out that the Chinese economy is facing several challenges at the same time: declining local revenues, more local governments directing funds towards various new energy-related enterprises. Even those sectors like solar power and photovoltaics are already experiencing negative growth, and poor performance in the A-shares market, which in turn affects primary market financing. Additionally, the combined effects of the downturn in the real estate and the stock market, along with widespread salary cuts across companies, have hit household wealth and income, further impacting consumption and family investments. This has led to a reduced contribution of consumption to China's economic growth. With the real estate market in a slump, several local governments have recently announced the removal of price restrictions on new homes, allowing the market to set prices. This move highlights the fact that the central government's recent efforts to support the housing market have not achieved the expected results. This situation is also reflected in Vanke Group's latest July sales data, which shows a continued decline. According to Vanke's recent announcement, in July, the company achieved a contract sales area of 1.5 million square meters, with sales totaling 19.2 billion yuan, a year-on-year decrease of 13%. For the first 7 months of this year, the cumulative contract sales area was 10.9 million square meters, with a total contract sales volume of 146.6 billion yuan, down 35.2% year-on-year. Earlier, on July 9th, Vanke disclosed its performance forecast, predicting a net loss of 7 billion to 9 billion yuan in the first half of the year, a year-on-year decrease of 171% to 191%. The net loss after deducting non-recurring gains and losses was estimated to be about 5 billion to 6.5 billion yuan, a decline of 157% to 175% year-on-year. This marks the first loss for Vanke since it was listed in 1991. Vanke is a state-backed company and often regarded as a top performer in the real estate industry. It has always been a leader in profitability. There was even a time when they earned a staggering 40 billion yuan in a single year. Even in the tough market of 2023, despite moving from profit to loss in the fourth quarter, Vanke still managed to hold on to a profit of over 12 billion yuan. In the first quarter of this year, although Vanke was still holding on, they only reported a loss of 360 million yuan. However, within just 3 months of the second quarter, Vanke's losses quickly expanded to 7 to 9 billion yuan for the first half of the year. This year, the number of real estate companies experiencing losses has continued to grow, with nearly 70% reporting losses. According to Wind statistics, as of July 15th, out of 61 A-share real estate companies, 41 are expected to report net losses attributable to shareholders, including 21 that have moved from profit to loss year on year. Among the 20 companies expected to be profitable, only 6 are expected to see a year-on-year increase in profits, while the others are all expected to see declines. The shadow of losses continues to loom over the entire real estate industry. Companies like Vanke, Gemdale, Shoukai, Financial Street Holdings, OCT, and CCCC Real Estate are all expected to report losses. For instance, Gemdale Group is expected to report a loss of 3 to 3.6 billion yuan in the first half of the year, compared to a net profit of 1.53 billion yuan in the same period last year. Shoukai is expected to report a loss of 1.9 to 2.4 billion yuan in the first half. Financial Street Holdings is expected to report a loss of 1.8 to 2.2 billion yuan. CCCC Real Estate is expected to report a loss of 1 billion yuan, and OCT is expected to report a loss of 900 million to 1.52 billion yuan. Many of these losses are related to aggressive land acquisitions by real estate companies in previous years, and Vanke has not been immune to this. The years 2020 and 2021 were periods of significant expansion for Vanke, with the company ranking among the top 3 in land acquisitions for 2 consecutive years. However, this was followed by a peak in housing prices. Acquiring land at the market peak and selling homes at the market low is a recipe for losses. Bloomberg reported that Vanke's sales continue to decline in July, exacerbating the company's liquidity pressure and making Vanke the latest focal point in China's real estate crisis. Analysts believe that Vanke's current strategy should focus not on losses, but on securing cash flow at all costs. In the first half of the year, Vanke has been selling off premium assets to generate cash flow. This includes 2 major commercial projects, selling Qibao Vanke Plaza, one of its top 2 revenue-generating properties, and selling a 48% stake in Nanxiang Impression City Mega in July. These transactions were completed at prices far below their book value. However, for real estate companies, sacrificing profits to maintain liquidity might not look good on the books, but survival is more important than anything. Bloomberg analyst Christy Hung issued a research report indicating that Vanke's solvency in 2025 and 2026 remains at risk. The cautious attitude towards private developers' pre-sales, along with a preference for second-hand homes, may hinder Vanke's recovery in sales and liquidity. However, Vanke's decline in July home sales was still smaller than the 36% drop tracked by China Real Estate Information Corporation, CRIC, for the top 100 real estate companies. Despite recent stimulus measures, the new home prices in China fell in June at the fastest pace in nearly a decade, reducing the incentive for people to invest in real estate. The real estate sector continues to drag down China's economy. Preliminary data from CRIC indicates that the top 100 real estate companies in China saw a 19.7% year-on-year decline in new home sales in July, totaling about 279 billion yuan, a faster drop compared to the 17% decrease in June. Transaction volume also fell by 36.4% from the previous month. At the same time, the time required to clear housing inventory is increasing. According to data from the China Index Academy, as of May this year, the average destocking cycle in 50 cities has increased by 3.9 months, reaching 21.3 months. The Chinese government, in its efforts to boost GDP, heavily promoted the development of the real estate sector. Under this encouragement, many people invested in real estate a few years ago, which led to an abnormal boom in the industry. This rapid development resulted in soaring housing prices and fierce competition among developers to acquire land, leading to an oversupply in the housing market. According to research by the People's Bank of China, more than 70% of urban household wealth is tied to real estate, and most household debt comes from mortgages. Data shows that 41.5% of urban households own 2 or more properties. However, as housing prices decline, the return on real estate investments has continued to fall. Investors are now facing the shrinking value of their properties and have started selling off some of their assets. Since March 2020, the number of listed second-hand homes in China has surged. By June of this year, the number of second-hand home listings in most first- and second-tier hotspot cities has surpassed 100,000, with some cities exceeding 150,000. In Chongqing, the number of listings in urban areas alone has reached over 200,000. The urgency of cash-strapped investors to sell has made transactions in the second-hand market more difficult, leading to a decrease in overall market activity. On July 30th, a prominent Chinese real estate columnist known as Real Estate New Talk commented that industry experts believe the golden era of buying houses as investments is over. For families owning 2 or more properties, the future may bring 3 major challenges: increasing difficulty in selling properties, a saturated rental market, and rising costs of property ownership. Real Estate New Talk suggests that China's real estate investment is now facing dual pressures of declining returns and rising costs. In the future, holding onto real estate might not only be unprofitable, but could also carry the risk of financial loss. On August 1st, the China Index Academy released data on the second-hand residential market for 100 cities in July. The average price was 14,653 yuan per square meter, down 0.74% month-on-month, with the decline rate slightly expanding by 0.01 percentage points compared to June. This marks the 27th consecutive month of month-on-month price declines, with a year-on-year drop of 6.6%. This trend of trading volume for price continues, with second-hand home prices in 100 cities collectively dropping for 4 consecutive months. By city tier, data from the Zhuge Data Research Center shows that in July, the average price in first-tier cities was 55,593 yuan per square meter, down 0.5% month-on-month and 5.7% year-on-year. In second-tier cities, the average price was 17,071 yuan per square meter, down 0.4% month-on-month and 8.63% year-on-year. In third- and fourth-tier cities, the average price was 9,140 yuan per square meter, down 5.3% year-on-year and 0.44% month-on-month. These figures clearly indicate that the difficulty in selling real estate in China is intensifying. Not only are sales prices and volumes for new developments sharply declining, but the second-hand residential market is also experiencing a downward trend.